Welcome to episode 16 of Nova Bourse US. Today, we are tackling a critical skill for any serious investor: how to read a 10K in 20 minutes. This is not about skimming. It is a systematic method for speed reading official SEC filings without missing the vital information that actually moves the needle on your investment thesis. We are going to strip away the noise so you can extract the signal from the most important document in finance. Most retail investors never actually open a 10K. Instead, they base their financial decisions on earnings headlines or social media chatter. But remember, a 10K is the only document where a company is legally required to tell the truth. It is audited by an independent accounting firm and filed under the strict penalty of securities law. Earnings calls can be spun by PR teams, and press releases are essentially marketing material. Think of the 10K as the company's memoir written under oath. You do not need to read all 100-plus pages to understand the business. You just need to know where to look. Let's have a reality check on the page counts to understand why so many people are intimidated. Take a look at the 2024 filing for Apple. It is approximately 52 pages. NVIDIA's 2025 filing is about 83 pages, while Berkshire Hathaway's 2024 report runs well over 117 pages. The average S&P 500 company filing sits between 60 and 120 pages. At a normal reading speed, that is 1 to 3 hours of dense, technical text. Our goal today is to compress that entire process into just 20 minutes through a strict, prioritized approach. What exactly is a 10K? It is the annual report mandated by the Securities Exchange Act of 1934, filed with the SEC through the EDGAR database. It is legally binding and filled with forward-looking statements protected by safe harbor provisions. You can tell a company's stature by its filing deadline. Large accelerated filers with $700 million or more in public float must file within 60 days. Accelerated filers between $75 and $700 million have 75 days, and non-accelerated filers have 90 days. Check the cover page to see where your company lands. It is the quickest way to gauge their market position. Every 10K follows the exact same structural map. Part 1 covers the business description, risk factors, and legal proceedings. Part 2 contains the selected financial data, the management discussion and analysis, and the full financial statements. Part 3 covers governance and executive compensation, which is almost always incorporated by reference from the proxy statement. Finally, Part 4 includes exhibits and schedules. You will notice that Parts 3 and 4 hold the bulk of the page count, which is exactly why we will spend the least amount of time there. This anatomy is your navigation system. To hit our 20-minute goal, we use a rigid time budget framework. We spend 0 to 2 minutes on the cover page and filer status. From 2 to 5 minutes, we tackle the business description. Minutes 5 to 8 are for risk factors, and 8 to 10 for selected financial data. Minutes 10 to 14 are reserved for the management discussion and analysis, while 14 to 18 go to the financial statements. Finally, we spend our last 2 minutes on the exhibits and auditor details. Treat this as a high-intensity sprint. Each section has a hard cutoff time. Start with a 2-second scan of the cover page. Identify the filer category box to see if they are a large accelerated, or non-accelerated filer. This tells you their public float tier and their deadline. Next, note the fiscal year-end date, as it often differs from the calendar year. Check if they are a well-known seasoned issuer, and verify the ticker symbol and exchange. These 4 data points take 30 seconds to capture, and they provide the necessary context for every single section that follows. In Item 1, the business description, do not read every paragraph. Instead, scan for 3 things: revenue segments with percentage breakdowns, geographic revenue splits, and the total number of reportable segments. Take Apple's 2024 report. They list 5 geographic segments, with the Americas at 43% of net sales and Greater China at 17%, while highlighting services as a growing separate line. If a company has more than 6 segments, consider that a complexity flag. Also, watch for customer concentration. If one client represents more than 10% of revenue, that is a major red flag. Item 1A is where the lawyers earn their fees. This section can run 40 pages, but you have exactly 3 minutes. Read only the bold-faced titles of each risk factor, not the descriptions. Ignore boilerplate warnings about industry competition. Instead, look for new risks that did not appear in the prior year and any quantified threats. Focus on specific issues like customer concentration exceeding 10%, reliance on a single supplier, regulatory actions with specific dollar exposures, or geographic sanctions. This is a high-speed search for red flags, not a deep-dive reading exercise. Item 6. The selected financial data is the most underappreciated part of the report. It offers a 5-year snapshot of key metrics on a single page, including net sales, gross margin, operating income, net income, earnings per share, total assets, long-term debt, and cash dividends. Use it as your helicopter view. For Apple, you can see their revenue peak at $394 billion in 2022, the dip to $383 billion in 2023, and the recovery to $391 billion in 2024. If a company omits this table, consider it a yellow flag. Item 7 is the Management's Discussion and Analysis, or MD&A. Executives use this to explain the why behind the numbers. It can be 30 pages long, but you only need to read the first two, the overview and the summary of results. This is where management explains what drove the year, such as product launches, macro headwinds, or strategic shifts. Skip the detailed line item walkdowns for now. If management cannot explain their business performance in 2 pages, that is a communication problem. These 2 pages give you 80% of the insight in 10% of the time. Item 8 contains the financial statements and notes. You have 4 minutes, so scan, do not study. On the income statement, look at 3 years of revenue, operating income, and net income. On the cash flow statement, compare operating cash flow to net income. On the balance sheet, look at total cash versus total debt. Save the notes for a later, deeper pass. Right now, your goal is triage. If any number has moved by more than 20% year over year, circle it for a later review. You are looking for anomalies, not performing a full audit. Your final 2 minutes belong to item 15. Confirm the auditor's name. If they have changed auditors, stop and investigate why, as that is a major red flag. Verify that the CEO and CFO certifications under Sarbanes-Oxley Section 302 are present. Finally, glance at the exhibit list for any new debt agreements or material contracts. If you see an Item 401 exhibit regarding the non-reliance on previously issued financial statements, stop everything and read it immediately. These 2 minutes are your ultimate safety check before you move forward with an investment. Knowing what to skip is just as important as knowing what to read. You can safely ignore Item 1B, which covers unresolved staff comments, as it is almost always boilerplate. Skip Item 2 regarding properties, unless you're analyzing a real estate or manufacturing firm. Skip Item 3 on legal proceedings unless you are a lawyer. Skip all of Part 3, which covers governance and compensation, as those belong in the proxy statement. Finally, skip the full notes to the financial statements on your first pass. These sections consume 40% of the page count, but offer near zero signal for a quick diagnostic. After your 20-minute scan, you need to answer 5 questions to decide if you should keep researching. These are not valuation multiples, but operational health metrics. 1. Is the business growing? 2. Is pricing power intact? 3. Are earnings backed by real cash? 4. Is the balance sheet sound? And 5. Is management returning capital to shareholders or diluting them? These 5 numbers form a pass-fail filter. If the answers are not clear or promising, you move on to the next company, saving yourself hours of wasted effort. The first number is revenue growth. Calculate the 3-year compound annual growth rate to see if demand is actually expanding. Look at Apple again. Their revenue went from $394 billion in 2022 down to $383 billion in 2023, then back to $391 billion in 2024. That is a plateau with a dip, not growth. For a growth company, you want to see a double-digit compound annual growth rate. Anything in the single digits or negative is a yellow flag unless you're looking at a mature dividend payer. Number 2 is the gross margin trend, which tells you if pricing power is intact. Look at NVIDIA. Their gross margin expanded from 72.7% in 2024 to 75% in 2025, even as revenue exploded from $60.9 billion to $130.5 billion. That is the gold standard, rising revenue coupled with rising margins. It means demand is so strong, they can raise prices faster than their costs increase. If a gross margin drops by more than 2 percentage points year over year, that is a red flag. Number 3 is cash conversion, which tells you if reported profits are backed by actual cash. Divide operating cash flow by net income. For Apple in 2024, their operating cash flow of $118 billion divided by net income of $94 billion equals a ratio of 126%. A ratio above 100% is excellent. It means they collect cash faster than they recognize revenue, often seen in subscription models. A ratio consistently below 80% is a red flag, often suggesting aggressive accounting, rising receivables, or bloated inventory levels. Number 4 is your net cash position. Calculate this by adding cash and marketable securities, then subtracting total debt. For Apple in 2024, they had $29.9 billion in cash, plus $126.7 billion in marketable securities, totaling $156.6 billion in liquid assets. Compare this to their debt. A positive net cash position means they could pay off all their debt tomorrow and still have money left. For non-financial companies, a net debt position above 3 times EBITDA is a serious warning sign of overleverage. Number 5 is the share count trend. Track the diluted weighted average shares outstanding over 3 years. Apple had 16.3 billion shares in 2022, 15.8 billion in 2023, and 15.4 billion in 2024. That is a 5.7% reduction in 2 years, proving their buyback machine is working. When share count falls, your ownership stake grows. When it rises, you are being diluted. If the share count rises by more than 2% per year without a clear acquisition strategy, that is a capital allocation red flag. Sometimes, 20 minutes is not enough. You must slow down for 3 types of companies. First, conglomerates like Berkshire Hathaway have dozens of segments with different economics, requiring more time. Second, financial firms like banks and insurers have balance sheets and accounting structures that are fundamentally different from industrial companies. Third, any company with recent restatements, auditor changes, or going concern warnings demands a full deep dive read. The 20-minute method is a powerful filter, but it is not a substitute for rigorous due diligence when you encounter complex or distressed situations. The core philosophy here is simple. Efficient reading is about allocating attention to the highest signal sections. The 10K is designed to disclose information, not necessarily to communicate it clearly. Your job is to reverse engineer the signal from the corporate noise. Use the 5 key numbers as a rapid diagnostic tool. Use the time limits to prevent yourself from drowning in boilerplate language, and use the skip list to protect your focus. If you master this, you will read more filings per quarter than most professional analysts, and you will understand the businesses much better for it. In our next episode, episode 17, we are putting everything from season 2 into action. We will perform a full case study on Apple, applying our knowledge of balance sheets, income statements, cash flows, and valuation ratios, combined with our 20-minute 10K scan. We will build a complete valuation of the world's largest company from scratch, step by step, live on screen. Make sure you have your notes ready, and I will see you then.